interest rates on the 30-year fixed have been holding steady since Labor Day at about 7.25, maybe just a touch higher than that. On this Wednesday, the Fed is planning to announce their potential rate hike for September, although most people consider that to be going to be a hold on the Fed, that they're not going to raise rates, they're going to keep them the same. So the question remains is, where are 30-year fixed rates going in the future? Because how can they possibly just stay at the same number? Well, it is possible, of course, but let's take a little bit more detailed look at where the market is going and some of the storm clouds, the big storm clouds that are on the horizon. So one of the first things I did when I came into the office this morning, Monday, was read Mortgage News Daily and their description of the 10-year market last week. What happened? And basically they say there's two ways to look at today's weakness in the bond market. On one hand, yields did a great job holding below the technical level of 4.34, but on the other hand, they also attacked that level on several times. So they're basically asking, is 4.34 going to be resistance, or is it just going to be something that once we get past, we're off to the races to much higher rates? So the next thing I obviously did was go over to CNBC and pull up the 10-year chart. And what do you know? We are once again attacking or leaning on 4.34. 4.34 is the resistance recently, and they're knocking on the door once again. You pull back on that chart and you look to see what's happened since, say, like March of 2020, and the trend has been pretty steady up. A couple of dips here and there, but more or less it's been straight up since March of 2020, and that's also reflected in the 30-year mortgage. This is the 10-year note. Let's take a look at the 30-year mortgage. And you can see quite clearly it bottomed out in the end of 2020, and since then it's just been on a steep increase with one little divot back in the winter of 2022. But other than that, it's been almost straight up. And as you look at the chart, say since 1980, you can tell that in the middle is somewhere like 8% or something. When you look at the chart going back 40 plus years, 7.25 is still probably lower on the lower half of things, I should say. It's approaching the median, but still less than the median. And that's also kind of basically true for the 10-year note. We're somewhere lower than the overall average for the last 45 plus years. I know you've heard of this thing where commercial real estate, there's a lot of outstanding loans in commercial real estate and they have to refinance them. And the problem is because they're coming due, and the problem is they either have to pay them off, which they can't do, that's a joke, or refinance them. And the problem is that they got these at 2 or 3, 4%, and now they're going to have to refinance at 7-something%, and that's going to be very, very expensive for some property owners in commercial real estate because the rents aren't there because of the whole work from home thing, right? Well, apparently that same thing effectively is happening with the federal government. Listen.
A new report from Apollo Asset Management tallies up the maturities on our impressive federal debt and concludes that $7.5 trillion will come due in the next 12 months, meaning it will either have to be paid back, which is a joke, or it will have to be replaced with brand new debt. The problem is this drains enormous sums from the productive economy. It leaves less for small businesses or households to borrow, so many will not be able to borrow at all. Washington already used it up. And those who do get loans will have to pay higher interest.
So when you have all these people in the marketplace looking to borrow, that's going to drive up rates, especially when the federal government is out there looking to basically finance not only their existing debt, which is about $7.5 trillion, but the existing deficit, which is another $2+ trillion. They're going to be looking to borrow like $10 trillion. And effectively, what's one of the key ways they borrow that money? Through bonds, through the 10-year bond, amongst others. And of course, the 10-year bond basically tracks more or less to 30-year fixed rates. So you can see there's going to be a lot of government pressure on this number headed upwards. Over the course of the year, if you've been watching the channel, you'll remember that I've been fairly bullish on the economy. But over the last, say, month, I've started to be a little bit more skeptical. You may have heard me put up like the weather watch sign, watch out for rough seas ahead. Hurricane warning. So I'm starting to feel a little bit queasy that inflation is going to be here for much longer. And again, remember, inflation continues to rob you in a cumulative effect because it goes up and up. And that inflation report that we had last week, that was not good news. That was not good news. Remember that most of the inflation in the headline number came from energy, and that is yet to really kind of ripple through the economy. The producer price index, which is the prices that manufacturers paying, that is still pretty hot. That is running hot. And with these fiscal and monetary policies of the federal government, a lot of people are saying to themselves, oh, interest rates could never go above 7.25. They could never go above 7.5. But look at the charts that we showed you in this. They have gone above that in the past, and theoretically, look at the trend, right? You cannot deny the trend, and the trend is this way. Now, it'd be great if everything, went back to 5.5% or something, but that's not the risk that we're looking at. The risk and the trend is up. All right, I'm Jack from Jack Gately Real Estate and the Online Real Estate Academy. Have a great day.